ladies and gentlemen. Thanks for tuning into The Scoop. I'm your host, Frank Chaparro, Director of Special Projects at The Block. I'm very excited for this conversation with Ric Edelman, founder of DACFP. Obviously, Ric is a prominent contributor to the American financial advisor world, an entrepreneur, author, and his contributions to the field of financial advisory and ETFs and crypto are well documented, and we appreciate him taking the time. This isn't your first rodeo. If you think back to 20 some odd years ago with the ETF explosion and revolution, you could call it, the incumbents didn't like ETFs back then either. Maybe walk us through that journey and maybe the parallels you see between these nascent days for crypto and asset management to those nascent days for ETFs.
You're right. This is not my first rodeo, and I come to this from a rather unique perspective because I'm not a crypto bro. I'm not from the crypto community, although I've been in the crypto space since 2012, so pretty early on. My introduction to crypto is pretty much the same as everybody else's. You first are asked about it or hear about it, and your reaction is, "Huh? What?" It doesn't make a whole lot of sense intuitively. But there were some pretty smart people talking about it to me back in 2012, and I figured, I don't understand what they're talking about. I don't get it, so I need to learn more. Instead of being dismissive and just throwing it away as a fad or a fraud, which is what most in the financial industry did in the early days, my attitude was there's got to be a there, and I need to either prove it, figure it out for myself so I can explain it to my clients, or dismiss it. And so it didn't take long of my research down the rabbit hole to realize two basic things. This is a big deal. This is a transformative technology that will have a massive implication on commerce around the world. And second, the financial services industry is largely unaware of this because the financial guys didn't invent this. And so they tend to be dismissive of what they don't create. So I created DACFP in 2015 to serve as a bridge to connect the crypto community with the financial services community to help the two reach each other, because there are two flaws independently here. The financial industry, by ignoring crypto, is ignoring a terrific wealth creation opportunity, a wonderful way for investors to increase their wealth. Separately, the crypto community, for doing all the wonderful whiz-bang cool innovation there, they too often fail to understand that if they ignore the financial services industry, they will be limited in their success. Financial advisors control 2/3 of the nation's wealth. My firm that I built is the largest independent advisor in the country. They're now managing almost $300 billion in assets for 1.3 million households around the country. And the crypto community needs to understand that no matter how good your product or service is that you're building, if you don't get the buy-in of advisors, the investors you're trying to reach, the businesses you're trying to serve, will not work with you, because those business owners, those investors, turn to their financial advisors for advice. And the first question they're going to ask the advisor is, should I do this? And if the advisor says no, gets it, game over. I've been on a mission for the last decade to educate advisors and their firms, because until they know, until they get it and understand it, they can't say yes. And if they don't say yes, their clients don't say yes. And that means you, in your efforts to sell that product or service or raise that capital, you ain't going to get anywhere. And the best evidence I can give you for this, Frank, is that here we are 15 years into crypto now, and 5% of the world owns Bitcoin. So good news, congratulations. It's a multi-trillion-dollar asset class, and it's only 5%. If you have any hopes of getting the other 95%, you better include the financial services industry. Now, this is a message the crypto community doesn't like, because many of them got into this business to overturn, to dethrone the financial industry. The last thing they want to do is embrace, work with, and champion the financial industry. Well, you got a choice. You can either be happy with your 5%, or you can do what it takes to go grab the other 95. And I'm hopeful you'll do the latter.
What's the breakdown of no and yeses in terms of financial advisors? How many are sitting in the no category for either anti-crypto reasons or just education reasons?
Yeah, it's morphed over the years. We do a lot of survey research. We work closely with let's say lots of advisors. I've got hundreds of thousands of advisors who follow me. I'm probably the best known financial advisor. I was named the #1 advisor in the country 3 times by Barron's. My firm is, I think, 7 years running the #1 firm in the industry according to Barron's. So we're pretty prominent, and we've been a thought leader in the financial industry for decades. You noted the ETF world that I championed way back in the early 2000s. Our firm was one of the earliest advisors to use ETFs, and we are, I think, still the largest ETF user in the industry. And we've pioneered. I invented one of the most successful ETFs in the industry called XT, the Exponential Technologies ETF, back in 2015. Yeah, I've done this rodeo several times of trying to help advisors understand what's new and different. You can't keep giving your clients the advice you were giving 20 years ago. What's the advice you need to give them now for the next 20 years? And so we do a lot of survey research to answer this question. And we have a series of surveys we've done with Franklin Templeton, one of the largest asset managers, who's also one of the leaders in crypto development technology. They were the first to launch, as you know, the first on-chain money market fund. They are doing a huge amount in tokenization. They've got crypto SMAs through Eaglebrook. They're really, really doing a great job. And the surveys we've done have shown really interesting data, Frank. 5 years ago, the vast majority of financial advisors knew nothing about Bitcoin and at the same time hated it. They regarded it as nothing but a fraud, at best a fad. If it wasn't an outright fraud, it was a tulip. It was a tulip bulb or a beanie baby. The only thing they knew was Mt. Gox and Silk Road, more recently FTX, which all helped to kind of reinforce their views that you need to stay away from this. What they are now shifting toward, however, and this is recent, this is over the past year to 18 months, advisors now recognize that this is here to stay, that it is a big deal, that it is worthy of their evaluation and consideration, and they still, however, don't know much about it. But the trend has turned, and we can thank the development of two things. Number one, the new Bitcoin ETFs that launched in January, and the fact that BlackRock got behind them a year ago. Because BlackRock, being the world's largest money manager with 10 trillion in assets, a huge reputation within the advisory community. And when Larry Fink said it's okay to get in the water, that meant it was okay for advisors around the country. So those two events, which kind of combine into one big one, have changed everything. So today, we've seen in the last 3 months a 70% increase in the number of advisors who say they're going to allocate to crypto within the next year. This is revolutionary. So advisors are now in the mode, Frank, instead of saying it's a fad or a fraud, ignore it. They're now saying, I don't understand it as well as I ought to. I'm not able to answer my clients' questions to the degree they expect me to, and I need to learn more. So they are coming to our organization, the Digital Assets Council of Financial Professionals, in higher numbers than ever because we offer the most robust financial education for advisors in this area. Our CBDA designation, certified in blockchain and digital assets, is a professional designation listed by FINRA that allows advisors to get the education they need, not just about crypto, because there's a lot of resources, including yours, one of the best, that help people understand what is Bitcoin, what is blockchain, how does it all work. There's a lot of those resources. What makes our course different is that we spend half of our course on practice management. What's the investment thesis? How do you build a portfolio? How do you deal with regulation, compliance, taxation? How do you explain this to clients? How do you integrate it into your practice? How do you train your staff? How do you develop the tech stack? How do you culturalize your client? And so we're very much in the trenches of helping advisors win clients, increase their assets, because that's what advisors care about. And that's a big, unique focus that we bring to crypto, which is why the crypto community works with us so closely, because they know that we can help them reach advisors in a way nobody else can.
Yeah, and I think that honestly, the space hasn't done a great job of reaching advisors. The
No.
way in which you describe sort of the adoption curve among professionals in the financial advisory space really resonates with me. I feel like out of all of the communities of financial services, they're kind of the latest to the game, so to speak.
Right.
You probably saw trading firms, market making firms as the earliest adopters going back to 2014, 2015. Then maybe, some of the payments folks, the technologists within these financial organizations kind of coming into crypto a bit later. And just anecdotally from my own experiences, I do feel like I don't know if it's sort of the role of an FA. It's so much more personal. It's so much more tied to these folks work with families and preserving wealth and guiding their clients through sort of major life events. But it almost feels like it even as you see an increase of 70% allocating, it almost feels like it's begrudgingly happening among them. Like they don't want
Yeah.
this to happen, but not out of sort of, my grandmother used to say, don't attribute malice for stupidity. It's not the greatest comparison, but I don't think it's out of like sort of beef with crypto per se. I think it's more out of like just wanting to protect, I guess, or wanting to safeguard their clients.
Well, there are two things to that, Frank. You're absolutely right about that. It isn't malice and it isn't obstinance. We have to understand the psychology of advisors, and there are a couple of things you need to know about this if you're in the crypto community trying to reach advisors or their clients. The average advisor in this country is over the age of 62. We now have more certified financial planners over the age of 70 than under the age of 30. The typical advisor looks like me, old white male. I've been in this business for nearly 40 years, and that's true of a great number of other financial advisors that are in this business 20, 30, 40 years and very successful. We're managing a lot of money for a lot of clients, and we're making a lot of money. Our clients are very happy. Just look at the performance of the stock and bond and real estate markets over the past couple of decades, and it's easy to see why clients are very happy with their advisors. And as a result, they're happy to be paying the fees to their advisors that they're paying. Advisors are making a lot of money, serving clients who are making a lot of money. Everybody's fat and happy. Why mess this up? Why do I want to bother as an advisor who's been doing this for 30 years? I'm now in my 60s. I've got hundreds of happy clients. Why do I want to mess that up? By talking to them about something that is totally brand new, totally different, totally unprecedented, that nobody really understands outside of the technologists. Especially when, think about this. What's the average allocation that an advisor will recommend to a client to invest in crypto if they're going to recommend it? What's the average allocation from your experience?
1% to 2%.
Exactly. So why should the advisor say, I'm going to blow up my practice, I'm going to risk my reputation, I'm going to put at risk the 98% of my assets in order to have my client invest 1% into this? Explain to me as a business person why I should bother doing this, when I can instead leave everything exactly as it is and play golf 2 days a week. This is the biggest issue, the inertia factor that we have to overcome to explain to advisors why it is in their best interest and it is in their client's best interest to do that 1 or 2 or 3% allocation without making it a huge challenge and a disruption to the advisor's practice. That's what we have to overcome. Too many people in the crypto community are so enthused about crypto, their whole life begins and ends with crypto, and they don't understand why other people don't feel the same way. And so they're having trouble communicating effectively to advisors because they don't really understand that advisors only have a 1 or 2% interest in this.
Mm-hmm.
So don't make me talk about this 50% of the time if it's a 1% allocation. And that's really the big part of the disconnect between the crypto community and the advisor community. They don't understand what makes advisors tick. They don't understand how to persuade advisors to engage, and that's part of the roadblock.
Well, part of what makes him tick is a big move like Larry Fink putting his weight behind it, so to speak. But what
Exactly.
else? What else resonates with them in terms of what about including Bitcoin in a portfolio sort of strikes a chord with advisors?
So we've talked about the inertia element because of where advisors are in their practice. There's another element related to this. And I say this lovingly to all of my fellow financial advisors, being the #1 advisor 3 times ranked by Barron's. Advisors are very lazy people. And I'm #1, so I'm the #1 laziest advisor of all.
You guys love going on vacations too. I feel like every other week my advisor's in Cabo or
Advisors know
Vail.
how to optimize our lives
They were doing
and
work from
practice
home
management.
before work from home was even a thing.
You know what? As long as we're able to serve our clients, everyone's happy. So the bottom line is, I don't want you to make my life difficult. I don't want you to make my client's life difficult. And this is why there's so much excitement about these ETFs, because prior to the ETFs, investing in crypto was hard. It's cumbersome, complicated. The KYC AML rules, the compliance and due diligence obligations, getting it through the investment committee. It was the products are cumbersome and complicated and a little bit scary and intimidating. But now the ETFs come along, they're simple, they're easy, they're familiar. We're all already using them. Clients are familiar with them. We don't need a new tech stack. I don't have to retrain my staff. I don't have to reculturalize my client. It's a simple, easy way to add this. And that is so much easier. And that is why Larry Fink has been able to be so persuasive, because if Fidelity, if BlackRock, if Invesco, if Franklin Templeton are all going to be doing this, well, what's not to love? And so it's simple and easy to integrate. And that's been a big major reason why advisors are happy to look at this. So all we got to do is recognize that this isn't hard. It isn't challenging. It isn't dangerous. And here's what it comes down to. We've talked about advisors are old and they're lazy, but there are also two other things. Number one, they're fiduciaries. Advisors want to serve their client's best interest. So advisors are open to ideas that can help them accomplish that goal. 5 years ago, the question used to be to an advisor, why are you buying Bitcoin? Now the question is, why aren't you buying Bitcoin? So as a fiduciary obligated to serve my client's best interests, that encourages advisors to pay attention. And then there's one final piece, and this one is, I think, perhaps even more fundamentally important to this. Advisors are smart. Okay, we talked about them being old and being lazy and being fiduciary. The final piece, they're smart. These people are really good at math. They're really good at analysis. They really understand modern portfolio theory. We get the Nobel Prize winning methodologies of investment management. All you need to do is demonstrate to us how adding Bitcoin to a diversified portfolio is better than not doing it. And now, 15 years into this, we have the data. We have all the historical information that advisors want to see that show very clearly, very persuasively, and factually that adding Bitcoin to a portfolio lowers the risk-adjusted returns, or the risk metric, and improves the risk-adjusted returns. The Sharpe ratio, the Sortino ratio, max drawdown, standard deviation, all these numbers get better. A portfolio with Bitcoin is actually safer than a portfolio without Bitcoin. And a portfolio with Bitcoin makes more money than a portfolio without it. So we can make the rate of return go up and the level of risk go down with an inclusion of crypto. And advisors are receptive to this. And once they understand that, they're happy to add this to the client's portfolio. As a fiduciary, it's in the client's best interest. As a lazy advisor, the ETFs solve my problem. And as an older advisor who's starting to think about selling my practice, I want to be able to market my practice as one that is dealing with the state-of-the-art, latest investment opportunities. This all works. It all makes sense. Advisors are not, it's not hard to persuade an advisor to do this.
Especially when it's easy and you can illustrate the extent to which it juices up a portfolio.
Yes.
But you need both, right? You can't just say including this is going to yield better risk-adjusted returns. You also need it to be easy for them to tap into and access this market.
So if you're building a product, if you're raising capital, if you have a fund, you need to make that product or that service easy for the advisor to integrate in their practice. And if you can do that and explain to the advisor that fact, you've got a winner. And that's what we do. We help the crypto community do all the above.
So now let's this is really good context, really good color for understanding sort of the mind. I feel like we're doing an outside, almost anthropological sort of case study here of this foreign creature known by many as the FA. Now, walk us through the practical sort of implementation of this. We obviously examine the flows, which are at an early stage, and it looks like price has followed the flows. You saw a March surge in ETF flows along with sort of rising Bitcoin price. They've been stuck in the relative doldrums since then. But I've said a few times in my newsletter, don't pay too much attention to flows. They're important, but at the same time, in baseball terms, we're probably not even in the first inning. We're probably still tying our cleats, as it were. So to what extent should we be examining these ETF flows at this early stage? And is it really just, I don't want to lead the question here, but is it really the tip of the iceberg in terms of all of the underpinning activity that needs to happen for so much of this industry to be plugged in? Now, they could get plugged in and then no one will want to buy it. That's totally plausible. But the plugging in part, for lack of a better word, that takes time. So I feel like the contention I'm trying to make here is, in this early stage, don't look too much into the flows because so much has yet to happen in terms of actually plugging into these products.
Yeah, you're right, Frank. Flows are the wrong number. I think we're all familiar with indicators, economic indicators, that there are leading, lagging, and coincident indicators. And flows are a lagging indicator. Flow tells you what has happened, not what is going to happen. And all we should really be caring about is what's going to happen. So stop looking at the rearview mirror. In other words, for someone to flow, for there to be an investment into Bitcoin, that means you already made the decision that you want to do it. And you already completed the due diligence process of choosing how to do it.
Exactly, Rick, you're making such a great point. So just real quick, because my view is that March bump, those folks that were allocating during March, those flows that were pouring in, I mean, that decision, whether it was on an individual basis or a firm basis, could have happened 6 months before the ETFs were even approved.
Oh, of course, they were waiting for the ETFs. The money was in cash waiting for the ability to buy the ETF. And on January 10, bam, there the money went. So we had huge pent-up demand because everybody knew the ETFs were coming. And then there they were, and there the money flowed. But the real issue is what's next. So again, you need to understand not just the mindset of an advisor, but the logistic practice management element of an advisor.
Exactly. We broke down the psychology. Let's get into the logistics.
So here's how it works as an advisor. First, the advisor has to decide, do they want to allocate? And they have to decide how much do they want to allocate and which of their clients are they going to allocate for? Because they aren't necessarily going to put 100% of their pool of assets and say, well, we're going to take 1% of total AUM, assets under management, and throw it into Bitcoin. They're going to decide first which of my clients is this in their best interest, and how much of that client portfolio am I going to do. Then they have to decide, how do I do it? So the Bitcoin ETFs are the easy answer at the moment, and there are 9 of them. So which of them are you going to allocate to? Are you going to allocate to just one, or are you going to allocate to a combination of 2 or 3 or 4 of them?
Never even thought of that. So how does that decision? Is it mostly fee-based, or is it which issuer is taking them out to the nicest steak dinners?
There are lots of reasons that you would choose one over another or a combination. Number one, steak dinners. I won't call it that, but I will call it relationships. Advisors are already working with a lot of ETF providers. So if I already have a deep relationship with Franklin Templeton or Invesco, then it would be natural for me to call my contact over there to talk to them about their new Bitcoin ETF. So relationships do matter because that, again, it makes it life easy for the advisor and their staff because they don't have to develop new relationships. Second, more pragmatically, what's the fee of the ETF? These fees range from 19 basis points to 150 basis points. So I want to choose a low-cost provider for my clients to help them save money. Third, who is the custodian? Fourth, who is the surveillance partner? Although all of these ETFs are only buying Bitcoin, Some of them are doing it in a different way, depending on their surveillance partner or their custodian. Also, who is this ETF provider? Some of them are broad-based experts in the ETF world. BlackRock's a perfect example of that. So is Fidelity and Franklin Templeton and Invesco. On the other hand, some of them are a very small company, relatively new company, but deep in crypto. And the best one to come to that mind there would be Bitwise or Galaxy, which is the partner to Invesco. So do you want to go with a big name ETF company, or do you want to go with someone who's deep in crypto? Well, this could argue for using two or three and do it both ways. That's, we love as advisors, we love diversification. So instead of putting all my money into one of them, let's put my money into two or three or four of them in an effort to spread out the expertise, the risks, the fees, et cetera.
So what happens after that decision's made?
Well, you've got to have the investment committee engage in this process of called due diligence to evaluate which of these ETF providers I want to use and in what combination. Simultaneously, the compliance department has to figure out under what conditions are we going to allow one of our investors to buy this ETF? Are we going to have the advisor proactively make a recommendation or reactively respond to an incoming request? And are there going to be parameters under which clients can invest? Certain age, certain asset level, certain education or knowledge level of the space. Some firms are actually requiring their clients to sign a waiver because of the volatility and risk of crypto. Some firms are making the client go through a 1-hour class because they want to make sure the client fully understands. Some firms are limiting which clients can buy or limiting how much they can buy based on either the account value or their overall net worth. The due diligence committee and the compliance department is engaging in all of this. At the same time, a third group, the planner management team, has to make sure that the advisors are knowledgeable because they can't let the advisor recommend a Bitcoin ETF if the advisor doesn't know anything about Bitcoin. So we need to get the level of training up so that the advisor is knowledgeable and fluent in this crypto conversation before they talk to the client, even after they've identified who the client is they want to talk to. So all of this process takes time. And the wirehouses, it typically takes more than a year because they don't want to be in a hurry. The last thing an advisor wants is to blow up his practice over something as trivial as a 1 or 2% allocation opportunity. So they're going carefully, slowly, thoughtfully, because they know at the end of the day, they're going to have to explain their actions to the SEC. These companies are examined by the SEC, if not annually, then every 2 years. SEC examiners walk in and they do an incredible deep scrub. I can't tell you how many SEC exams I've gone through in my career. I'd rather have a proctology exam. These things are incredibly difficult. They are incredibly time consuming. The SEC is incredibly thorough. They want to know not only what you did and why you did it, they want to know what you didn't do and why you didn't do it. So if you're going to recommend Bitcoin, they want to know why. And if you didn't recommend Bitcoin, they want to know why not. You've got to document all of this. You've got to be able to show the data, the analysis, the rigor of how you reach the decision to advise the client the way you advise them in a manner that is in the client's best interest. Firms have to not only do all this stuff, they have to document all this stuff to the satisfaction of the firm's chief risk management officer and chief legal officer and chief compliance officer and chief investment officer, all to be able to say to the SEC, what we're doing is in the client's best interest. This doesn't happen overnight. This takes months, can take years. The fact that the financial industry has been moving so fast, JP Morgan, Goldman Sachs, Merrill Lynch at B of A, UBS, Wells Fargo, they are all falling over themselves, racing to get these ETFs into the market because they know their clients want it, their advisors want it, and the price of Bitcoin is rising so fast, if they wait too long, they'll miss out on the profits. That'll expose them to other legal issues. So it's amazing how fast they're all working on this. Does it mean the flows are there yet? No, but that's the last part of it. Look at the beginning part. Are they engaged in the due diligence? Are they engaged in the research? Are they evaluating this? Are they training their advisors in preparation for going with a launch? That's what you should be looking at. Talk to the ETF providers. Ask them, how many conversations are they having with the financial services companies, the investment advisory firms, the brokerage firms, the asset management firms? Let's see what level of engagement there is. That's the leading indicator that's telling you what's going to be coming in Q3, Q4, and Q1 of next year. You think you've seen a lot of flows, Frank, so far? You ain't seen nothing yet.
Great song. So we walked through the psychology of an advisor. We walked through the sort of this logistical element of how sort of new funds are maybe incorporated into a sort of portfolio. That whole process of due diligence, legal, to sort of then being able to offer it to the client. Let's maybe examine or unpack the portfolio construction element of this, because there are many ways that an advisor might think this could work in a portfolio, in terms of whether it's maybe it's sort of replacing a tech component, or maybe obviously a lot of people think of Bitcoin as sort of gold 2.0. So there's a precious metal element, or a safe haven element, if you would. How do you sort of think about it? How are most financial advisors thinking about it? Obviously, most people, I think most listeners will know the 60-40 breakdown. Does it take a little bit out of the 60? Does it take a little bit out of the 40? What does it look like?
Generally speaking, you're right. There's, start with that 60-40 matrix that represents most firms' overall allocation models. My view, and this is pretty consistent with what I'm seeing everywhere, the crypto allocation is coming out of the 60. It's coming out of equities. And that makes sense. I mean, Bitcoin at the end of the day is an ownership asset. It's not a debt security. So it should not be taken from your bond position. It comes out of your equities. It is an equity, just like gold is an equity, real estate's an equity. Those are just forms of equities. So the 60-40 is now becoming 58-40 and 2, or 59-40 and 1, or what have you. Where the complexity gets into a little more of a mishmash is when the advisor has a bit more detailed allocation strategy than merely 60-40. In other words, what does the 60 represent? Is it all public equity, meaning you're just buying stocks through mutual funds and ETFs, or you're buying individual stocks, in a brokerage account? Or are you going a little bit deeper? Are you articulating alternatives, for example? Many advisors have an alternatives sleeve that's inside the 60. They'll have 5 or 10 or 20% allocated to energy and water and metals and precious metals and other natural resources. They may place commodities in their futures or margin account. They may place Lord knows, they may place emerging markets in that category as a separate sleeve aside from ordinary stock investing. And if they're going to have an alternatives sleeve, does crypto belong there? And if so, does that mean they're going to increase the size of the alternative sleeve, or are they going to reduce some other alternatives holdings to make room for the Bitcoin? Individual advisory firms will make individual decisions as they see fit. As a crypto provider, I don't think you care a whole lot. What you care about is the fundamental allocation decision. Is it 1, 2, 3% of the portfolio? You can help the advisor figure out where to take it from in the portfolio, but at the end of the day, you really don't care. That's up to the advisor. And part of their decision making will be not only their empirical investment management strategy, but their marketing strategy. How are they going to explain this to the client? And depending on their goal, what kind of client do they serve? What do they feel is the client need or concern or objection? They'll figure that out from a practice management perspective. For the most part, you and the crypto community don't have to worry about it too much.
So let's talk about the methodology behind your price target of $420,000. That's a nice price. How do we get there?
Yeah, this came about because I have seen, like all of us, so many price predictions from so many folks, a lot in the crypto community, but also the Wall Streeters are now starting to come out with their
Yeah,
own.
Kathy Woods is like 2 million or something.
Michael Saylor says 5 million. Standard Chartered says 350,000. JP Morgan has got a prediction of, I think, 500,000. Everybody's got predictions out there. And here's the one piece of good news. Every prediction I've seen is higher than today's current price. So that's good news. Or maybe not. Maybe that's a contrarian signal. But anyway, what I haven't seen from anybody is how they got to their number. How did they, how do they specifically get there? Remember, we're as advisors, we love math. We love the data and the analysis, and I haven't seen the explanation. So it got me thinking.
There's a lot of stock to flow out there.
And so I've got a 1-hour webinar on this. You can access it for free at DACFP.com, DACFP.com, and watch the 1-hour webinar explaining in detail how I get there. I also have a spreadsheet, my spreadsheet that I use to produce this, that I'll send to you for free. Just, shoot me an email and I'll send you my spreadsheet and you can play with the levers. It's simple and easy to do. But here's what it comes down to, Frank. Make it real simple. I'll give you my 30-second summary of it. Take a look at the entire world's assets, the global stock market, the global bond market, the global real estate market, the gold market, the energy market, the Bitcoin market. That's itself $1 trillion. Add it all up. The total value of the world's assets is about $740 trillion. If the owner of those assets, and these are retail investors, these are investment management companies, these are sovereign wealth funds, family offices, endowments, pensions, all over the world, all the money that's being held by all the people who own it, and the people who are managing the money on behalf of the people who own it, right? Just the whole industry. If we collectively allocated just 1% to Bitcoin, that's $7.4 trillion. There's 19.4 million Bitcoins out there right now on the march toward 21 million. Do the math. 7.4 trillion divided into 19.4 million Bitcoins, 420,000 per Bitcoin. So it's real simple. Now, what you'll have to ask is, will everybody in the world who owns assets equally allocate 1% to Bitcoin? No, of course not. Some will do more, some will do less. You got to make that decision. And will they do just Bitcoin? Or what if they allocate a little bit to Ethereum or to Lord knows what? So, you can play the math on your own. My spreadsheet will help you do that. But the bottom line is, if you really believe the world's going to have a 1 or 2 or 3% allocation, by the way, now we know how Michael Saylor gets to 5 million. Because I'm assuming 1%. Michael assumes a bigger allocation, and that's how you get to 5 million.
Fair enough. So even sort of with that, all the things we've talked about, why are there some FAs that are maybe still resisting? And is that just sort of, you're always going to have a few sour apples?
I'll tell you why. It is because, and this I have found across the board, because I do a lot of training, a lot of presentations, a lot of activities with our work, and I come upon thousands and thousands of advisors. And those who object the most to Bitcoin, who argue that it has no inherent value, no intrinsic value. You've heard Jamie Dimon say this. Warren Buffett calls it rat poison squared. The advisors who hate Bitcoin the most, I have found, tend to be some of the smartest, most experienced advisors in the industry. People, look at Jamie Dimon, look at Warren Buffett, right? These are incredibly intelligent, experienced individuals. And Jamie sits in front of Congress and says it's only good for sex trafficking. I'm like, heads explode. So here's why. Here's why I say that the older you are in this business, the more experience, the more expertise you have, the more you struggle is because of your experience and expertise, your training. You see, we know as a financial advisor, as a money manager, we know how to value stocks. We've been doing it for decades and we're good at it. We look at the company. what is the size and duration, experience, history of this company? What are the products that they manufacture? Who's the management of the company that's leading the way? What's their level of research and development? Who are the competitors? How much profit are they earning? What's the revenue? What's the profit line? What's the margin? And we know how to evaluate all of those numbers compared to competition to determine, should I buy Coke versus Pepsi? Should I buy Delta versus United? Should I buy biotech versus big pharma? This is what we do, and we do it really well. And Wall Street firms have legions of analysts who do nothing but that. Along comes Bitcoin. And these folks are using their decades of experience for asset valuation, and they're applying it to Bitcoin. The problem, though, is that they say, well, Bitcoin's not a company. It's not a product. There is no management. There is no competition. There's no revenue. There's no profit. All of these numbers are zero.
Don't work. They don't work.
And therefore, Bitcoin's intrinsic value has to be zero. Their heads explode. They can't get their arms around it. And this is the problem, is that they're trying to use their traditional asset valuation metrics on a brand new asset class that is totally unrelated to any of that, and they don't get it. These are the same people who would argue the Mona Lisa has no value. They would argue that a Babe Ruth baseball card has no value. Every time I see somebody saying Bitcoin doesn't produce income, therefore it's worthless because there's no income flow, I'm like,
sure,
there isn't any income flow to the Mona Lisa. That hasn't stopped anybody from arguing that. Or gold, that doesn't produce any income, but people buy gold. I'm not arguing that they're wrong on their methodology. I'm arguing they're using the wrong methodology.
The application of it is wrong.
And this is the problem they have. And increasingly, advisors are beginning to recognize that they are going about it the wrong way, that these old, established, expert advisors are beginning to acknowledge that they've been listening to the wrong people. Listening to Warren Buffett has been incorrect. Jamie Dimon has been sending them down the wrong path, that they have been missing out an incredible investment opportunity on behalf of their clients because they have been trying to use a square peg in a round hole, and they now realize they need to look at it in a different way, and they're now asking, for the first time ever, I'm learning, over the past year, they're coming to us saying, it's time for me to ask what's up with this, because the way I've been looking at it obviously hasn't been right.
And they can come to you for those round pegs. That's what they need. We'll leave it there, Rick.
Frank, it's been a pleasure. The work you're doing is awesome. Keep doing what you're doing. We need more folks like you. And any way I can be helpful, let me know. That's all we do at DACFP.com.
Likewise. And where can folks learn more about what you guys are working on?
We have our webinars that we do a couple of times a month, lots of content on our site. I encourage you to take a look at our CBDA program, our Certified in Blockchain and Digital Assets program. If you've got new staff, it's a wonderful way to get them up to speed really fast. If you're trying to understand the advisory marketplace and what makes them think, this course is really for you. It's now 5 different tracks in 9 languages. We've got people who've gone through our course, Frank, from 37 countries.
That's incredible.
So yeah, it's all, everything you're looking for is available at DACFP.com.
Awesome. Thank you again. Mm-hmm.